Okay, everybody, episode 3 in the market structure series. This is going to be a deep dive into live charts, going through what we have learned in episode 1 and 2 and piecing it all together. So in episode 1, we looked at parent and subordinate price swings. We looked at the model we're looking to see on the lower time frame at those highs and lows at the institutional reference points. And we also looked at protected lows and protected highs and how we can utilize those to get in with sync with price on a higher time frame. In the second episode, we looked at dealing ranges and premium and discount and parent and subordinate premium and discount ranges. In this episode, we're going into live charts to piece it all together. So guys, if you've not already watched those episodes, please make sure you watch them first. Otherwise, none of this is going to make sense. Okay, but let's get straight into the good stuff. So where we're going to start is on the weekly, because what we need to understand is that depending on which time frame you are trading on, there is always a parent price swing. So if you trade on the daily, well, then the weekly is your parent price swing. If you trade on the hourly, you'll be referencing the daily. If you trade on the 15, you'll be referencing the hourly, and anything 15 down, you're referencing either the 15 or the hourly as your parent price swings. Okay. So when we are looking at the daily, we want to be referencing where we are on the weekly, and the same principles apply. It doesn't matter what time frame you're trading on. What we've gone through in episode 1 and 2 is applicable on all time frames, any stock, any indice, any commodity. It's always the same. Okay, so what we have is this low, which creates a new high when it validates this high. Okay, this is what we were talking about in episode 1. This validates this as a protected low when it creates this new high. Okay, so when this high violates this low, what do we have? We have a market structure shift. So what are we anticipating? Well, we're anticipating price to pull up into a premium for price to continue to the downside, right? Into a discount of a weekly range, okay? Because we're moving from a premium, right, of this dealing range, moving from a premium down to a discount, okay? And we have witnessed a protected low being violated, price moving up into a premium before moving down. So going back to episode 1, what do we have forming right here? Well, we have this high form, this low, this high, this low, which violates this former low, return up into a premium, continuation down. This is that exact model we discussed in episode 1, albeit on the weekly. Okay, so we now know that our bias is bearish as we're looking for price to now move down into a discount. If you're inside Red Pill, then you'll have known that we anticipated this to be the seasonal shift where we now drive down into weekly discount. Now, if we jump onto the daily, this is where we can start dialing this in. So this is the low which creates the high. Okay, so price comes back into a discount fair value of this range that was created. It then moves back up into a premium of this range before moving down. This is ahead of that break of market structure, anticipating a higher time frame break of market structure on a lower time frame. The daily is a lower time frame, right? So what do we have here? This goes into episode 2. This is just engineered liquidity, right? Inside of fair value, right? So once we see price break this high 3 candle formation, right, which creates this low, okay, creates this break in market structure. So we're anticipating price to pull back up into a premium. Okay, so how could we have traded this utilizing what we have learned already? So what I do is look for the most relevant high which breaks this low, and it's this swing high, okay? So it's 3 candle formation that creates this low, which breaks this. As soon as this is broken, this becomes our intermediate protected high, albeit it's at fair value. So what do we know? Price moves from a discount to a premium. So this is a protected high, but it is a intermediate protected high. So what we know is that price is going to move into a premium. So this range on the daily is the range I'm interested in because this is the range which created the displacement. This range, okay, after when we left. So price moved up into a premium, 62%. Right? And what I'll note at this stage, guys, in the previous episode, I do know I said 72% as the other side of the optimum trade entry. It's 79. So please don't change your fibs. It's 61.8 and 79%. Okay. It's a mistake on my part. But when price gets into this premium, what could we anticipate? We can anticipate price pulling down into this discount of this daily range to accumulate more positions long to take price into a premium. Now, what I'll say at this stage is if you've watched episode 1, I personally like to see a candle close above a high which creates a low to validate a proper market structure shift. So when price moves up into this dealing range premium, this is where we could anticipate on a lower time frame for price to move back down into a discount. A discount of what, I hear you ask? Well, this is a new range. Why? Because this low violated this high and closed above it. So when it closes above this high, this becomes our protected low. So what can we anticipate? We can anticipate price coming back to fair value. Okay, and when it gets to fair value, what can we anticipate? Price moving back up into a short-term premium. So what has been engineered on the lows at fair value? Liquidity. So we know that we're in a higher time frame bearish profile on the weekly, and on the daily, we are trading in cahoots with that. So we're not looking for price to come back down into this range, which would be OTE of this dealing range, to take price higher, because our weekly profile is bearish. And we're looking for price to now run the lows. Inside of Red Pill, we traded this short, knowing that we had a seasonal shift on the highs. Okay, so that is using what we have learned so far with protected highs and protected lows on the weekly and daily to frame bias. Okay, so we can dial this even further. When this low was created, here, did it violate this high to create a new protected low? No, so these are all weak lows. You'd anticipate price to break these lows and then drive towards this sell side liquidity, right? This was the other thing we discussed in episode 2, price driving for liquidity pools. Okay, so we've engineered liquidity. We've just moved up into a higher time frame premium after a higher time frame market structure. Now we're looking for higher time frame pools of liquidity. Okay, and we're using the daily as our reference point. So now let's jump down onto a lower time frame and see how that works on the hourly. Okay, so on the hourly, we had this protected high. This high, which created this low. So what has that created? It's created a dealing range, right? So on this day, what could we anticipate price to do? Price to pull back up into a premium. At any point, did this high get violated? No, so we don't have a new protected low, which validates a low because this high hasn't been taken out. So this is the same dealing range when we flip it. And so price moves from a premium back down into a discount, taking out this sell side liquidity, right? This engineered liquidity before price ultimately moves from a discount through this dealing range high to take buy side. Once we've taken buy side, price moves lower and violates this low. This was a old protected low, but this was a protected low at fair value. So this is a weak protected low. So price violates this low, creating a new high. The high which takes out the low becomes our new high. So what did price do? Price gets down to a former point of interest before moving back up into a premium and then wicking back down again on a lower time frame. So this is the hourly and how we can utilize what we've been going through over the last couple of episodes to get in sync on the hourly. But we can go even further. We can jump down to 15 minute. So let's have a look at 15 on this day. So this is the Friday the 22nd. So how could we have got in sync with this price action on the 15? Well, briefly, we can just use one of the other ICT concepts is when a SIBI is filled and we're anticipating lower prices, once this is filled into a higher time frame order block, this becomes an intermediate term high. So we're automatically not anticipating this high to be ran. Okay, and I've done episodes on intermediate and long-term highs if you want to watch it on my YouTube channel. But this is a market structure episode. So when this high creates a new low and closes below this low, validates this as a protected high. So what are we anticipating? Price to pull back up into premium. So price pulls back up into a premium. Sure, it wicks through, but where are the bodies holding? Their bodies are holding inside this premium range. And ultimately, it didn't break or close above this old former protected high. So when price comes all the way back down here, did we create a new low to validate a new protected high? No. So the sustained dealing range is in play. Price comes back up into a premium before displacing lower to tackle what? Sell side liquidity. This is a higher time frame pool of liquidity. We then run down into that discount on the higher time frame. Okay, on the higher time frame. So what do we have? Is we move this lower. Well, this high created this low. So this is our protected high. So we are anticipating price to do what? Pull back up. But what do we need to know? We need to know that this 15-minute high, where does it sit? It sits inside of a discount of the hourly dealing range. So the hourly protected high is up here, right? So if we just sync this across our charts quickly, this is the hourly protected high. So we need to know that there's always a parent. The parent to the 15 is the hourly. And we know that we're in a discount of this hourly range. So we could anticipate price to do what? Pull back up into fair value or a premium. This is a protected high, but it is a weak protected high because it is inside of a discount. So on this low, do we get a new low that's created here that violates and closes below this low to validate a new protected high? No. So this is our high. So we'd anticipate price to draw up into these highs. And there's ways we can spot this on the lower time frame, and we will go through that shortly. But ultimately, when does price violate that high? Well, it violates it here. So this becomes our protected low when it closes above this high, right? Ultimately, it chops around here a bit. What does it do? It stabs up into a deeper premium of the hourly, the parent price swing. Once we're inside of a premium, what does it do? Well, it runs down into a discount, does it not? It runs back down into a discount, this range. What is it doing? It's sweeping this sell side liquidity. Okay, that's been engineered before moving higher after offset accumulation, something we discussed in episode 2, running into this premium buy side. Okay, so what do we have when we're up here? Well, we have a low which creates a new high. So this becomes our new protected low. And then when this low closes above this high, what do we have? Well, we have a new protected low when this low closes above that high. So when price violates this low, closes below this low, what do we have? Well, we have a new protected high. Okay, so what can we anticipate when sell side is ran into a discount for price to do? Return back up into a premium. Returns up into a premium before displacing lower. Why? Because our higher time frame profile on the weekly and daily is bearish. Okay, let's have a look at how this looks on the 1 minute and how we could have got in sync with this on the 1 minute using the 15 minute as our parent and subordinate swings. So on the 15, if we go over here, we know that this was our parent swing, the parent swing high, right? The high which created the low on the 15. So this was our price swing. Okay, price moves back up into a premium. It wicks through here, but ultimately we knew that this was an intermediate term high after filling that 15-minute CIVI. Okay, what do we get on this high? You know, you may not have taken this, but ultimately this is what we're looking for every single time at these points of interest. Low, high, lower low, purge of the buy side, break, right? Where's our protected low in this? Well, our protected low is all the way down here, right? So, you know, you may have wanted to wait. Sure, you may have wanted to wait. Does it violate this low? No. Did we get a new high form here? No. So you may have wanted to wait. Where do you get an actual true breaker structure? We get it here. Okay, but when you're here, what are you going to be wanting? What are you wanting to see? We want to see price get back up into a premium. Okay, because none of this has been mitigated. Right? So what does price do? It chops around here for a bit inside a discount of this dealing range before moving back up into a premium of this range which created a break of market structure. Okay? Did a new low get created? So do we have a new high? No. So the same dealing range applies. So price pulls back up into a premium. And what do we have here? Well, we have that same model again. High, low, higher high, break. What do we get? Well, we get a return into a short-term premium inside of a higher time frame premium, expecting lower price to draw down to higher time frame sell side liquidity. Okay, so it's at this point we can start following lower time frame order flow to support higher time frame price action, and we're using protected highs to do that. So once price comes back up into a premium and we have this model that we're looking for, this is where we just follow price action. So when do we get a new protected high form? Well, when a low gets violated. So this low gets violated here, right? When it puts in a new low. What does price then do? Returns back up into a premium. Okay, before moving lower. When it violates the low and creates a new protected high, we're following price action. When it breaks, creates a new low, new protected high, creates a new low, and so on and so forth. Why at this point would you be conscious about getting into a position short? Because you're now inside of a discount. So this is where price can move back up into fair value of this range again before moving low. So this is where you either want to be holding runners, which is a lamb to slaughter, or trading with very limited risk. Okay, and ultimately you're just taking price down to a discount, which is a higher time frame discount, right? Which is going back inside this rejection block after price ran down into previously 50% of this range, right? So it's at this level where you could be anticipating price to retrace or reverse to get back up into that premium. So we now know that we had this protected high on the 15 that was weak, right? But what are we looking at on the lows? So on the lows, on the 1 minute, we have it here. High, low, which violates former sell side. Break, return into a discount before price moves higher. Where would you be wanting to take partials? At a premium of this range, the subordinate price range. Not looking for price to drive through this protected high to get into a higher time frame parent premium. Okay, so this is when we were talking about anticipating lower time frame breaks in market structure to create higher time frame breaks in market structure. So we know that this is a protected high on the 15, but it is subordinate to the higher time frame parent. This is the hourly high, protected high. So let's just clear this for a second. So this protected high, which created this low, is the parent price swing. So anticipating price to get back up into a premium of that range. This is a weak low as it's inside of a discount, right? It becomes a weak low. So price chops around this fair value before ultimately stabbing up into a premium. Okay, so when we're in a premium, how can we anticipate this on the lower time frame? Well, what can we do? Well, we've just engineered a whole host of liquidity down here, right? And we're inside a parent higher time frame premium. So what could we anticipate? We can anticipate price drawing back down into a discount on the lower time frame, right? So we just flip this around because at no point on the hourly have we validated at this point a new high. So this is still a low. Okay, so on the high, where could we look to frame an entry? Well, again, using time and price, but that's in a later episode. We have a high, a low, a high, which violates this high, and a break. What are we looking for? Price to return it into a short-term premium. Fair value, bam. So this is where we could be framing our entries to go short to then do what? Drive down into a higher time frame discount, taking out this short-term intermediate sell-side liquidity, right? So what do we do when we get down into a discount? Well, we have this exact same model. And I'll say at this point, guys, you can use a lower time frame than a 1 minute to anticipate a 1 minute break of market structure. Time is fractal. Okay, so this low, high, low, high, low, if you studied this on a 15-second chart, you will have a break of market structure. Return back into fair value before price breaks the protected high on the 1 minute. So this is the protected high. This is the high which creates the low on the 1 minute, but we've used a 15-second, because I'm reading these candles, to anticipate a 1 minute break of market structure. So when we get a 1 minute break of market structure, what can we anticipate? Well, price putting back into a discount. Why am I choosing this low? Well, this low created this high, right? So I'm anticipating price to come back down into a discount to move price higher, okay? And this is when we were talking about being careful, because as you can see, price moves higher, right? And you'd be using this low, which created this high, as your protected low. But this is where you've got to be careful. It's going into episode 2 of using a protected low inside of a premium, because price is likely to pull back into a discount to accumulate, offset, accumulate, right? This sell side liquidity that's being built up to then move price higher. So what are we now doing? We've got a lower time break of market structure into a 1 minute break of market structure into a higher time frame break of market structure. All right, anticipating a higher time frame break of market structure using the lower time frame. Okay, so price drives up and takes out this hourly high and closes above it. So we have a new low form on the hourly, which would be this low. This would be our new protected low. Okay, so going long here is risky, right? Right, because we're inside of a premium. At no point does price even come back to fair value. It's all in a premium. And because our higher time frame, daily and weekly, is still bearish, this is where we could anticipate price to move lower, right? To go and take this liquidity all the way down here. Okay, because it's just purged hourly buy side that is subordinate to the daily, which is bearish. Okay, so once price takes this buy side on the hourly, we could be anticipating lower prices, especially as we're inside of this dealing range premium. Okay, so what do we have here? Well, we have price move higher. This low is the low which creates this high, right? So when it breaks, we have a market structure shift, but at no point does price get into a premium when it breaks. So you'd be hesitant chasing this. You'd stay patient, waiting for price to come back up into a premium before price moves lower. Okay, this is where you get caught chasing price, right? If you're just dumping on this, because price hasn't come back up into a premium. Where does it come back up into a premium? Here. So here you have that same model, high, low, high, purges the high, break a market structure. What we're looking for, return into a short-term premium, but then price to drive lower. Where would you be taking the majority of your position off? Inside of a discount. So either at fair value or inside of a discount of this dealing range. And if you're anticipating lower prices because you're on side with the higher time frame bearish price action, you'd be looking for the lows to get ran, right? So when this breaks this low, so we've now broken a higher time frame hourly protected low, what could we anticipate? Well, we could anticipate price to pull back up into a premium, right? So this now becomes our range. Okay, this low to this high. This is the high which created the low. This high created this low, right? So this is our protected high. So price comes back up into a premium before moving lower again in a macro picture, which is bearish. I hope you found that useful and it ties together what we've been going through in 1 and 2. If you have any questions, guys, feel free to ask them in the comments question, or you can jump in Red Pill Trading where I trade live every single day. Okay. But that being said, that's going to wrap up this episode. It's going to wrap up part 1, part 2. Episode 3, we're going to go into mitigating and unmitigated ranges. All right. But until then, trade safe, trade smart, and I'll see you on the other side. Abash!